Good morning. Thank you for joining us at Capstone Coffee Conversation. My name is Brian Skogstad, and we are and Brian Felshaw is joining me from the Silverdale, Washington office. And we're going to kind of ping back and forth a little bit today. It's a little different, but we're sitting in different offices and both wanted to kind of come to you with some different pieces on what we're going to discuss today. So we're going to bounce back and forth a little bit between Brian and myself. I'll kick it off this morning. And as we do, we'll have about 15 minutes of prepared discussion points. But if there's anything that you have questions on, please message into the host, and Ayla will bring those questions to Brian and myself when we're all done. And we want to make sure that we are covering the things that you want to hear covered. So we'll talk about a few things today. Number one, a little bit of a recap of the last month and where we've been. Brian will hit on kind of what things are priced, what we feel like attractive today, what things have done well lately as well. We'll talk a little bit about where interest rates have gone, and a lot of movement recently. So we'll talk about that a little bit. And Brian will cover some historical context of markets just to make sure that we keep everything in perspective. And then last, we'll hit on just a few pieces of the partnership and transition with Wealth Enhancement Group, as we know we've had some questions in regards to that as well. So first, let's just hit on where we've been the last month. We did not have a Santa Claus rally, unfortunately, this year. A Santa Claus rally meaning the month of December and sometimes into early January, markets have a nice run and they do well. That's called the Santa Claus rally. And most years, historically, and at least in the near future, in the near past, have seen a nice Santa Claus rally. This was the opposite this year. We had more of we'll call it the Jack Frost rally, and markets really limped into the end of the year after what was a pretty good 2024 up until that final quarter, definitely the final few weeks. 2023 was a good year. 2024 still a good year for stocks, some better than others, but the end of the year definitely lagged behind. The main culprit of that decline in the last handful of weeks there was the Fed coming out mid-December and saying that they are only going to lower interest rates, potentially, only going to lower interest rates twice in 2025 is their target. Before, they had been expecting to lower interest rates 4 times in 2025. So we all know that I like low interest rates. People like low interest rates. The economy likes low interest rates. It makes it easier to borrow and to buy houses or cars, and it makes it easier for companies also to borrow. So we all like lower interest rates. And so the Fed cutting their outlook in half sent stocks into a little bit of into a downward trend. Definitely hit the small cap, mid cap stocks a little bit more than the large, as smalls and mids use more financing and debt to grow more than large caps do. But all across the board saw a decline the last few weeks and even into a little bit into January. So that's where we stand today. The one thing that we have heard a lot is with the election over the last couple months also. And I think that we always try to keep in perspective, like, what do we want to make investment decisions on? Do we want to make it, based on the election, or do we want to make investment decisions based on valuations relative to history? Where are interest rates relative to historical norms? Where are earnings? That's kind of, we try to look at where's the best value for every dollar and try to make allocation decisions based on those types of issues. And yes, the election will kind of make some of the policy things change, and we can figure out those tweaks as we need to, as things come in, and maybe things change slightly. But we try not to just make investment decisions based on how we feel about if our party won or lost. Lo and behold, 51% of the country was happy this November 5th, and 49% was angry. And if we go back 4 years, guess what? 51% of the country was happy, 49% was angry, and it was just a flipped 51 and 49, right? But over the last 2 presidential cycles, We had President Trump and President Biden in for the last 8 years. Both presidents, although being very different with extremely different policies and agendas, both had 3 positive years in the market and 1 negative year out of their 4-year term. So I think a lot of times we give a little bit too much credit or too much fault to those in the White House on what the economy is doing. But we think that most people base their spending decisions or their, kind of how we're gonna grow our family budget, what have you, based on things like job security and income and how much it costs to live. And some of those pieces are what typically make the economy move more so. So that's kind of what we try to look at is where is the environment today, and make allocation decisions based on that. Brian, I'll pass it over to you.
Yeah, I think that was really well put. And just to echo that, I think December proved that as far as the market's concerned, the Federal Reserve is still the big gorilla in the room. That the market cares about Federal Reserve actions more than politics, more than holiday season spending to a certain extent. That has a big impact still more than anything else. So zooming out a little bit and looking at what happened in 2024, some things that did well versus some things that look attractive heading into this year. 2024, when it comes to stocks, was in many ways a repeat of 2023. We saw continued dominance and outperformance by the big tech. Sometimes we call those the Magnificent Seven stocks, on the backs of excitement and the possibilities of what artificial intelligence could do, and those companies' investments into that space. That has happened 2 years in a row now versus all the other sectors of the market. The question is, heading into 2025, will that make a three-peat? History says that's going to be difficult for the same trend to continue 3 years in a row. It could, but where valuations for those Magnificent Seven lie today versus the rest of the market suggests that in 2025, it would be difficult for them to have that same outperformance. We'll see how that turns out, but that's one thing to keep an eye on. What that suggests then is looking at other areas of the market, namely value companies, dividend-paying companies, companies that produce more of the basic needs and basic staples like energy and food and things that are outside of that technology space, are at better attractive valuations than the big artificial intelligence tech companies. So we have tried, as Ryan opened with, looking at where is the best bang for our dollar in terms of client accounts. How can we weight more towards where things are a little bit more reasonably valued so that we can be better positioned for what may come or what may not come. Just to give you some numbers on that, that large growth category, according to JP Morgan, is 150 is the valuations of that large growth category in the US is 150% over its historical valuation. So there's been a lot of excitement baked in to what those companies could do. Large companies continue to outperform small companies. And the question again is, will that trend continue? The Federal Reserve, as Ryan said, plays a big role in that because smaller companies rely and are more sensitive to what interest rates are doing so that they can get financing. So that's something to pay attention to as well. Another big topic that we saw play out in 2024 was cryptocurrency. We saw Bitcoin rally over 100% in growth last year in 2024. And the question is, will that continue into 2025? It seems that there is still a high demand for that sector. And as long as demand is higher than the supply of Bitcoin that can be purchased, then that would suggest that Bitcoin could have more upside. But at the same time, we know that cryptocurrency is a very, very volatile new asset class and can have big sell-offs as well as its big run-ups. So we need to keep our eye on that and see what happens there. It also can be tied to the Federal Reserve, whether investors are thinking risk on or risk off in terms of where interest rates are going. So the themes that we are thinking about is how do we stay ahead of the curve and make sure that we are helping clients adjust their accounts to areas with the best valuations. And sometimes you have to be a little contrarian. Sometimes I'm having lots of conversations, Ryan, I don't know about you, but lots of conversations with clients that are very excited about what artificial intelligence could do for the future. And as much as that's great news, we also have to look at the valuations of those companies and have good conversations about where we want to take risk and where we don't.
Yes, I just a little history. I'm just gonna sidestep for a second. When I first got in this business, I became an advisor in May of '01. We were about 1 year into the tech bubble slide and 2 years to go. So the tech bubble began and the decline began about March of 2000, and markets went down until about March of 2003 or April of 2003. So it's about a 3-year slide. I entered 1/3 of the way into that slide and began my career at a pretty difficult time. The advisors that I was learning under as I was just getting into that business said, even though the markets were doing extremely well in the late 90s, it was the most difficult time to be an advisor that they had ever encountered in their career, because people were throwing out valuation and didn't care. And even though the stocks that were expensive kept getting more expensive, and advisors were trying to encourage people to diversify, take profits, move to other things that hadn't done as well. And people just wanted to own .com names, which were very new and had no earnings, but they had gone up for like 4 years in a row. And so this is not a time to, I'm not likening today's environment to the tech bubble. That's not where I'm going, but valuations might not matter until they do. And what we've seen is some of the most expensive areas continue to get more expensive, and they do have momentum, but we try to balance how much do we want in momentum versus how much do we want in valuation, because at some point momentum will work against you, and what was going up and never going down will go down and never come back up. Not never, but will go down and go much further than you think. And so those are certain things that we like to look at, is even though sometimes it's hard for us to say, hey, this area hasn't done well or hasn't performed, it's much cheaper. Valuations do matter in the long run. One thing that we do like today, fixed income is becoming more attractive again, right? So if the Fed says we're not lowering interest rates as much, then interest rates are staying higher for longer. And we saw the Fed lower rates the first time in mid-September. They've lowered rates 3 times so far in this lowering cycle. And September, November, and December, they lowered rates, and they've lowered them by 1%. So the Fed interest rate has come down 1%. But what we've seen is the long-term bond, the 10-year treasury, has gone up by over 1%. So even though the Fed is lowering rates on the short term, the long-term bond is actually going the opposite way. And so when interest rates go up, that means bonds get more attractive to us, right? So the more that we can lock in higher rates, the better. So if mortgages, and like, gosh, buying a house is difficult, mortgage rates are high. If you're the borrower, high interest rates are frustrating. But when you are the owner of bonds, the holder of those coupons, high interest rates are a good, secure way to make a good amount of income today, especially relative to the last 25, even 30 years. Bonds are paying more today than they really have since the late 90s. And so that is becoming more and more attractive. If you have stocks at somewhat high valuations and bonds paying more than they have for 25 years, that's a pretty good trade-off to keep rebalancing and make sure that some of your portfolio is getting a high rate of return, or a good rate of return for relative to the amount of risk that they are taking. So just a thought there. Especially if we kind of think that markets might be a little bit more sideways. If we have high valuations and we've had 2 pretty good years in the market, it's hard to see stocks just continue to plow forward as we've seen. So seeing some choppiness is definitely on the table. And so having a good portion of money in highly rated fixed income is making sense. Over the last month, 2 months, we've seen stocks go down in the neighborhood of 5 to 10, 11%, depending on which types you're talking about. And that's very normal, you know, just to put the drawback in perspective over the last 6 weeks or so. We always expect a 10% decline in stocks, and that is not surprising. So, and a lot of times that doesn't feel good, but at any point, and Brian's gonna give some historical context to this in a second, at any point, stocks could have up to 10% decline, and that is perfectly normal, even in good markets. So Brian, I'll turn it over to you, and why don't you pull up your slide discussing that?
Yeah, Moesha, if we could share, we have one slide here to put in context some of the volatility that we've seen in December. Ryan mentioned, you know, a 10% move down in slides doesn't, a 10% move down in stocks at any point doesn't actually surprise us that much. Here's why. So what you're seeing here is a history of US S&P 500 companies dating back to 1980. And this probably is very familiar to a lot of you. I refer to this slide a lot because it's so important. The gray bars show us how much did the market grow or go down in any given year. And so what you'll see there is most of them are positive. There's a few years that stick out, like 2008, the market went down quite a bit, but most of them are positive and well into the positive at times. Where I think this slide has a lot of value is in the red dots. The red dots show us what was the lowest point inside of each year. So if we just take 1980 there, for example, you know, the market was up over 20% by the end of the year, but at one point it was down 17%. So there was probably a lot of people who may have panicked when the market went down 17% and never got to see that upswing and recovery. If you draw a line through all those red dots, you're looking at about a 10 to 14% average move downward per year in stocks. That's the normal. What we've seen the last 2 years with very small moves down in the market and mostly just really good returns has actually been abnormal. And so, you know, Ryan referred to, it wouldn't be surprising if we saw a choppy year and maybe a little bit more of a return to normal in terms of market pullbacks. That could happen because parts of the market are going into the year higher than they have been in the past. So our view of this is that what we saw from the peak in beginning of December through now is actually a normal pullback, not necessarily something that we are making drastic changes because of. It's actually something that we expect and try to prepare clients for by going into the best valuations possible so that we can avoid the major swings that come with not paying attention to valuation and momentum. I think I always tell clients, if there's one slide that I could have on my mirror in the morning when I'm brushing my teeth, it would be this slide, just to remind myself that these moves are normal and they lead to the growth that we need to see long term. So, Moesha, you can take it down now. So what we've seen is normal, and I think having that reminder of that stocks do have periods where they pull back, but and knowing that the last 2 years have not exactly been normal, we've been a little spoiled, and to expect more normalcy going forward. One thing I'll add, Ryan, before I turn it back to you, is I think the last 2 years we've seen a lot of money in the economy in things like short-term bonds, CDs at the bank, because interest rates have been good. And so whenever there has been a dip, that money has been easily liquid and moved into stocks whenever there's an opportunity to buy low. And so I think that's my theory on why we've seen some of the dips the last few years just get bought right back up right away. The question is, does that continue? We'll see. It depends on many factors that we've just talked about.
Thanks, Brian. Last, I just wanted to close with some updates with our partnership with Wealth Enhancement Group. I know we kind of filled some questions, and we've tried to be kind of forthcoming with information to you, but just wanted to give a little highlight of a couple things that we have seen. I remember the last time I opened a bank account and they send you home, even though it was just a simple checking account with an ATM card, they sent me home with a packet that discussed international wire fees, home equity loan interest rate percentages based on tiers, return check costs. You get this packet, and that's just in opening a simple bank account. 99% of that packet does not pertain to me and my simple bank checking account, right? The same kind of happens when we have to sign an investment advisory agreement. Some of us have very older investment advisory agreements that we have to get updated. But anytime that you receive kind of the new packet of a new group doing the compliance going forward, there's a packet that comes along with it that has to describe every type of account or relationship that somebody could have at some point anywhere in the country. The bulk of everything that we do is staying the same for our clients. So, and the bulk of that packet does not apply to any one of our clients or the account that we work with. So everybody's account staying exactly the same, investment structure and choice is staying exactly the same. Our investment autonomy is staying the same. Everything is staying the same. Wealth Enhancement Group is going to pick up the back office compliance, technology integration, state regulatory filings, taxes, everything down to the copier lease. They are going to do all of the non-client work for us, or kind of handing that off to them, allowing us just more time to just work with clients, do investment management, financial planning, but everybody's structure and how they're working with their advisor today will be the exact same afterward as well. So if you have questions, please let us know, but just want to reiterate some of the information that's coming. Most of it doesn't pertain to how we work with clients, but they have to send the packet of all potential choices to you. And we have those choices, and we've had them at Capstone, and we'll continue to have them as the Capstone team at Wealth Enhancement Group. All those choices are available to us and always will be, but how we work with clients typically is the same structure that we have with each of you, and we'll continue that. So that is all of our prepared remarks. Ayla, do you have any questions you want to turn around back at us?
Yes, there are a few questions that came through. First one, is Capstone now a subsidiary of WEG? If so, what are the advantages and disadvantages?
It's not a subsidiary. We retain our pod. So Wealth Enhancement Group is just like Capstone. So, but bigger. Capstone Wealth Advisors is a registered investment advisory firm. It was started in Salem, Oregon. And Capstone Wealth Advisors did the compliance in-house. We did the technology in-house in Salem, Oregon. And as we built a platform, other advisors from other areas, Silverdale, Bellevue, Wenatchee, Bellingham, Las Vegas, Florida, linked into that platform. So Capstone was growing by other advisors kind of latching on to the Capstone platform. Wealth Enhancement Group also runs a platform. So as our complexity and as our growth has come, the complexity of running that platform, cybersecurity, data breaches, things like that have become much more difficult, just to be frank. We were at a point where we would either have to really grow spending and hiring and try to make this much bigger enterprise, or we have hired Wealth Enhancement Group to take on that platform role for Capstone. So now Wealth Enhancement Group will run the compliance and the data security and all of that, and all of the advisors at Capstone will now be under the Wealth Enhancement Group compliance platform. So we've always had compliance, we'll still have compliance, we just won't be doing that in-house any longer, but our group will remain the Capstone team under the Wealth Enhancement Group compliance platform.
And the next question, not all stocks are overpriced. Which area of the market offers the best value?
Brian, do you want to hit on that one?
Yeah, I think I'm muted. Yeah, we're good now. Yeah, I think ironically it's in the name, right? Large and small and mid value companies are at a discount compared to the large growth. And typically, these definitions can change, but typically, the last couple of years, value has been things like energy, healthcare, utilities, consumer basics, things like that. Think kind of the old physical economy as opposed to the new digital economy. Those areas are, I wouldn't say that there's any area of the market that is dirt cheap, undervalued, a great buy. That typically happens whenever the market comes down. But the value areas are at a discount compared to the big growthy tech areas, in a nutshell. Anything you'd add to that, Ryan?
Yeah, I would just say that you mentioned it in the name too. In choppy markets, dividends matter more than markets that go straight up. This is maybe just a side comment, but dividends, are coming in on a consistent basis. And if you have a choppy market, a 2% or 2.25% to 2.5% return is helpful. When market's going straight up, do dividends matter? Nobody cares. When markets are going sideways and you're able to collect dividends on a consistent basis, that matters.
And a lot of those companies pay good dividends, as opposed to the larger growth technology companies that want to keep their earnings and reinvest them into the company. Those other companies typically do pay good dividends.
And there's 2 more questions.
Okay.
Next, what does it mean for the increase in the interest rate for the 10-year treasury bond?
What it means is that that could go a lot of different directions. For your bond that you're holding, when rates go up, bond prices go down. So it means the bonds that you're currently holding have gone down in price a little bit, but going forward, you will earn a better return going forward. So bond prices move opposite of interest rates. So we've seen bond interest rates go up, so bond prices have gone down, but we're at a point now where I think it gets harder for bond interest rates just to keep going up and higher. So when bond interest rates go up, we're getting more income on the fixed income now that we hold, and it gives a better chance to have price appreciation because if bond interest rates are, if they're as high as they're going to get or close to, then the chances that we'll see bond interest rates go down at some point, and then you get price appreciation. So that's how it affects your bonds that you're holding. But what it means in general is that not as many people are buying the 10-year treasury. And so the US government says, hey, we're putting out some bonds. And if not enough people raise their hand at 4%, then they have to raise the rate to 4.5%, 4.75%, until enough people raise their hand and say, we'll buy that. So what it means in general, though, is that people are not buying the long-term 10-year treasury as much as they were before.
Can I add to that, Ryan, too?
Yeah. Mm-hmm.
So I think, that we've talked a lot about rates the last year and a half and how we've tried to pay attention to the range that 10-year has been in. I think it's fair to say 4.8 is on the higher end of that range the last year and a half. And we've seen it go as low as 3.7 or so on the lower end. And so whenever that rate has floated down, we've said we should probably buy less of that longer term bond. And when it's higher, we should buy a little bit more. So in the same thing, trying to look for value for clients. Whenever that rate has been higher, you and me, Ryan, we've talked about, hey, should we buy a little bit more for clients? And whenever it's been lower, we've said, well, let's wait and see and pause maybe and see where this goes.
Last one.
Last question, is Bitcoin a real asset class?
I think it is. Yes, it is an investable asset class today. Just like people can buy gold as an ETF, you don't have to go buy gold bars. If you want to own something that moves like gold, you can buy that in your account. Silver, copper, oil, etc. You can buy those in your account and have the price movement be exactly the same. The same as Bitcoin. You can do that for Bitcoin. You can do that for Ethereum today, and buy ETFs of new cryptocurrency type asset classes. And I think over time, they'll become more and more of a recognized investable asset class by other institutions, even governments. Some governments are putting it in their reserve today. You're seeing large wirehouses and brokerages begin to approve the adoption of letting people or their clients buy Bitcoin and what have you. So I would say it's still in the infancy stages as being its own asset class, but I would say yes, crypto is an investable asset class and probably will continue to grow or be more adopted as such as we move forward.
Just add to that too, one thing that we're keeping, tabs on is with the emergence of these crypto funds that you can invest in, eventually do those get approved for things like mass market 401ks? That would be another step in that big adoption of the new asset class and would open up the door to a lot more investors and therefore a lot more demand for those types of things. So just that, it's gone through this evolution of legitimacy and there's still more to come.
All right, well, thank you for joining us. We kept you here a long time today. Appreciate your patience and being here, and thanks for the questions. Feel free to follow up with your advisor if you have anything else that you'd like to chat about, and we'll see you hopefully next month for our Capstone Coffee conversation. Thank you.